$100 divided by $10. If you're risking $10 a day, how many days is that going to be? That's the question. It's going to be 10 days. It means that you will have about 10 opportunities to come back and make money in the financial space. Welcome back to another video, guys. Now today what I'm going to be sharing with you guys is stop loss placement and fear. We need to talk about these things. I feel like they're one of the most underrated and probably the least spoken about topics in the market space, and I think it's very essential that we cover this because a lot of people are struggling with these things, but they do not want to talk about them. They do not want to address them. So that's exactly what we're going to be addressing in this video, and then later on we will be doing some analysis. Right, I'm not going to keep this video very long, so let's get straight into it. Okay, so stop loss placement, I think it's potentially one of the biggest issues that people are not paying attention to. And I'm going to ask this question, simple question: what's the first thing that you do, you yourself as a trader? What's the first thing that you do before taking a trade? First thing that you do before taking a trade. A lot of you are going to be talking about, yeah, I calculate my pips and my take profit. I follow my trading plan. Yeah, I draft off a plan for my trade, and you understand. But everyone starts out with the wrong thing. Most retail traders, they start out with the wrong thing. Even though they do have a trading journal and trading plan or whatever the case may be, they start out with the wrong thing. Here's what you guys need to understand. If you've got $100 account, Jesus Christ, my handwriting is atrocious. Okay, if you've got $100 account, just a simple example. If you've got $100 account, okay, the mouse is tripping. If you've got $100 account and you want to trade this money, you want to grow this money, the first thing you need to understand about this money is you need to understand that some of it is going to go down the drain. You will lose it. Some of it is going to be lost. Okay, so you need to first calculate how much of this money are you willing to risk per trade. Okay, some individuals will tell you about, yeah, you need to risk about 10%. Right, you need to risk about 10% per trade. Some people will tell you 1%, some people will tell you 2%, but the percentage part doesn't necessarily apply at all times because the spreads will be different for different brokers. Slippage is also a factor that we need to consider. There's so many things that could potentially alter how much you risk or how much you're willing to risk per trade. All right, so let's say, for example, you risk about $10 per trade, which is the average that you actually can risk on most brokers, of course, right? From that $100. So it means that you would have to be willing to risk what? 10% of 100 is $10, right? $10 per trade. Okay, $10 per trade, but it shouldn't just be per trade, it should be per day. Okay, because understand something. The first question that you need to ask yourself when you invest that $100 is, how many days could I potentially be able to come back into the market to trade until the account is blown? That's the first thing you need to know. Okay, how many days would it take me for me to blow this account if I were to take losses every day? And then if you say $100 divided by $10, if you're risking $10 a day, how many days is that going to be? That's the question. It's going to be 10 days. It means that you will have about 10 opportunities to come back and make money in the financial space. If you've got the right mindset, if you've got the right trading knowledge, trust me, there's no way you're going to blow that $10 account. There's no way. Sorry, not $10 account, your $100 account. There's absolutely no way you're going to blow this money. Okay, so this puts you in a good standing if that is how you choose to start, or if that is how you actually start. Okay, because now if you're going to risk, say, maybe $20 per day, then obviously your days are going to now decrease from 10 days to 5 days. So you see how much risk works. That's exactly how risk works. Some people don't even last an hour with $100. Some people don't even last a minute, because people have got this mentality of, yeah, if I jump into the market right now and make a quick 50,000 from that $100 account, I'll be rich. Forget all that. You need to understand something, that the amount of risk that you're applying onto the account is gonna be determined, or rather is directly proportional, if I should put it in mathematical terms, directly proportional to the amount of time that you are giving your account within the market trading space. Okay, you need to understand. So the longer you are in the market, the high likelihood that you will actually make some money within the financial trading space. So we need to get that out of the way. Okay, start off by deciding how much do you want to risk per day. Okay, do the calculations. How long would it take me to lose this entire account, or how many days would it actually take me to lose this entire account if I were to take losses intentionally over the past couple of days? And starting off with a $100 account, if you're risking $10 per trade, or per day rather, to be more precise, then that's going to be 10 days. So do exactly just that. Because understand one thing, once you have taken away the $10, once you have taken away the $10 risk, then the next question is, how much are you willing to make per day? Are you willing to make 2 times what you are risking? Because if you're willing to make 2 times what you're risking, then obviously that account is going to grow much quicker. And at the same time, even if you do take a loss, it's going to still be doubled. You will recover your losses much quicker. Okay, if you are risking $10 to make $20 back. You understand? So that is now out of the way. You have literally started off on the right foot when you've done that. Now, stop loss placement. Since we are currently in a very, very long range on our 1 hour time frame, I do want to give you guys the stop loss placement trick here. You come to your 1 hour time frame. I'm just going to make an example of, let's say we're not in this long range right now. Okay, let's just say each and every candle right now is primary structure and we're not in a long range. Okay, so if you were to open a trade over here right now, where does your stop loss go? A lot of you are probably going to be like, yeah, no, my stop loss is probably going to be somewhere up here. That's the worst possible place you could set your stop loss. The reason why you do not want to set your stop loss here is because for as long as this candle is still running, this candle is still a trading range. Price is still more or less likely going to retrace back into this high over here, kick you out of the trade before it even gets here, and then start selling. And then you'll be like, it's manipulation, it's not manipulation. That's how price works. Okay, you just need to know and understand that each and every candle is primary structure. So retracements are happening almost every other time. Okay, so you want to skip the first candle after where you took the trade. Okay, if you execute over here, this entire candle, you will skip it all the way to the high, and then you will use the next candle's high as your stop loss placement area. That's what you want to do for yourself, and always use the 1 hour candles. Okay, why do you want to use the 1 hour candles? Because if primary structure gets broken on the 1 hour time frame, then prices completely moving in an opposite direction. Okay, and it's not going to stop up until it gets to the 4 hour primary key level before it starts selling off, if it is going to continue selling. Okay, it's like, for example, even if you were to take a trade here, you're not going to set your stop loss up here. You won't. It's probably one of the worst areas you can set your stop loss. You shouldn't set your stop loss over here. Skip one candle. In this instance, this would be the most relevant high. This one is about the same level, so we are not going to consider this candle. This high, we're going to consider that candle's high. So your stop loss, potentially a good place for it would be right there. So you would skip this candle as well as that one. I don't even consider that one, in fact. So good place would have been to set your stop loss right about this key level over here, and then boom, you avoided any risk. Okay, so it's such things that you guys need to know and understand. If you do not place your stop loss at the right place, trust me, you will get kicked out of the market. It's going to be like the market is literally just looking for your stop losses, and the reality of it is the market isn't looking for your stop losses. You just don't know how to place stop losses, and it's essential that you guys it's essential that you guys understand how to place your stop losses. It's a need for you to know how to place your stop losses. That, or you can just forget about trading altogether. Okay, so jumping straight into analysis, we had a lot going on yesterday. I'm not sure if you guys still remember, I made a video yesterday and we were looking at yesterday's day. And remember that I plotted out the POC. I think I showed you guys while I was plotting out the POC over here. All right, I did speak about the POC yesterday. Whenever the price comes to the POC, about 80+% of the time, price retraces from the POC. This right here is a key level or key area where the most transactions took place in the market. Okay, we don't know if it's buys or sells. We just know that it is the most transactions that took place. They could have been pulling out their trades, or they could have been taking profits. They could have been doing anything from this key. It could have been executions. We don't really know. Okay, but we do know that this is the most important key area in the market. Okay, at any given time. So whenever price gets to a POC, usually there's going to be a retracement. Now, as for why it retraced all the way back to this high over here, we were targeting our secondary, our primary 4-hour key level as much as our 1-hour key level. My argument here would have been we're targeting our 1-hour primary key level. Okay, but just price decided to go all the way high to our 4-hour as well. Doesn't really matter. What matters is we understood the assignment. Price was selling and we also jumped into the sell. That's really all that matters. That's really all that you need to know. Okay, so long-term outlook here. I think I remember the other day, I think it was the previous day before yesterday, I made another video. I was talking about how we needed to take out the high, okay, or the low of this long trading range. We've already taken out this range. Okay, we've now shortened the range. It's not long anymore. So what we do know here is we are dropping. Okay, we are selling into the secondary key level at this current point. Should we break that key level, price is targeting this new 8-hour key level. This is an 8-hour key level. I'm going to show you guys that in real time as we go about this. And then that is a good first take profit target area. Okay, second take profit target area would potentially now be, and if we break this key area, then our new key level is going to be this one over here. We're not going to consider this key level anymore. Okay, why? Because it doesn't matter anymore. It's invalidated already. Okay, we're not looking at that history no more. It's not useful for us to be eyeing it out and saying, yeah, no, this is still a good key. It's not anymore. It's useless. Okay, it's useless. So we've broken bearish on the 8-hour time frame. Since we've broken bearish on the 8-hour time frame, this then becomes our new key level. That's exactly what I meant when I say this is now a relevant key area for us to look to take profit from. Okay, Should price break and close below that key level over there, then we can expect even lower prices to the downside. Okay, that is what we have on US 30. Let's quickly jump over to the Nasdaq. What's happening on the Nasdaq? Let's come back to the 1 hour time frame. Nasdaq has recently looking bearish over here. We're retracing back to the secondary key level on the 1 hour time frame, and on the 4 hour time frame we are fairly bullish. See, we also broke that long range move a while ago. In fact, that didn't take long, but anyway, it looks like we are retracing back to the 1 hour secondary key level. Should we break that key level, then we are expecting even lower prices, because price is reaching over into that 4 hour fair value gap. So we just need to eye out this key level. Okay, because everything that happens right now is going to determine what happens next. As for the Nasdaq, it is fairly bullish. Okay, on the primary it is bullish, but on the secondary it is bearish. Okay, as we were retracing back to this key level over here. There's a daily fair value gap, and we just tagged it. Okay, we mitigated it. Right after that mitigation it took place, what do you see price doing? Retracing back to the daily fair value gap. Okay, now what happens next here is going to be determined by how price plays out, okay, for the remaining number of minutes in the market. Should price break and close below our 4 hour key level, which is our primary key level right here, it's game over. We officially are going to be expecting price to sell even lower. Okay, it's literally that simple. And if you look at the 8 hour time frame, you'll notice that this was the 8 hour time frame secondary key level. Okay, a relevant key level. And back to our 1 hour time frame, you might want to watch out for this key level. It is essential. Okay, it is essential that you watch out for this key level, because if it is broken, then like I said, it's game over. It's that simple. So looking over at yesterday, we had a lot of transactions taking place around that region over there. There was a whole lot of choppiness yesterday. It was crazy. Anyway, this key level right here is an essential key level. Okay, you might expect price to tag this level, and maybe there's going to be a potential retracement back to a specific key level to the high before a continuation of the sell that we are expecting, but only and only if price breaks and closes below the secondary on the 1 hour time frame, and then that is going to trigger an official sell. Until that happens, do not expect anything special. Okay, in the meantime, this is all I have for you guys today. I hope you do find value from these videos that I'm making and sharing with you guys, and do take this knowledge, use it, don't use it. Really, there's nothing that I lose out of it. There's probably something you lose out of it though. But anyway, thank you so much guys. I hope you do enjoy these videos. As always, I'll be seeing you guys on the next one. Cheers.